if you got, could get an echo. If you get all that, should be good to go. Awesomeness. All right, let me get this moved. Okay, so let's dive into this. I guess I can delete this part now. Yeah, and it's interesting timing too with the way the market's currently even closed. So what I want to do is I'm going to do a quick review of kind of like what the big picture is. And this is like the first 6 or 7 slides. And so I'm going to go through this a little bit more quickly because I've reviewed this a couple of times. But this is just, I think it's good to understand if you're newer to this, you just kind of understand like what's the driving force of everything that's happening, out there in the world, because there is a specific driving force, and the better you understand it, then the more you can kind of understand kind of what's happening. And then the 3 things we're going to talk about today are going to be the big picture, which is what we're going to start off first, updates on the 18.5-year real estate cycle, and then talking about the shorter term, also known as haddock cycles, and where we are and what's shaping up with all of that. Okay. Good. Debbie, I hope you're logged in from sunny California, sunny San Diego, and all that kind of fun stuff. All right, so first let's discuss population. And again, this is a non-political, I look at economic things, based on what's happening. I don't, really care about political policies or anything like that. So um, what moves the markets and stuff like that. So let's talk about population. So bigger picture, there's of course the idea of an aging population, possible declining populations. That's part of it. But in the short term or in the immediate term, one of the most important things to any economy is its immigration policies. And and by this I simply mean, I'm not talking about voter rolls or anything like that. I'm just talking about, if there's essentially more people, there's more people buying things and all the kind of fun stuff. So more people does equate to more GDP. That doesn't mean that don't not necessarily want everybody coming in, but it is a fact of the matter is that immigration is good for the economy. And the reason it's good for the economy, let me get my little drawing pen here. Da, 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 da. And the reason it's good for the economy is that there's a ratio here that kind of drives a lot of the policy decisions, is that it keeps the debt to GDP at a manageable level. Okay. So if you think of this as like, so think of, your household GDP. So, maybe you and your spouse work or whatever it is. And let's say, combined you make, 100 150K, 150K a year. And then, if you've got, um, say, mortgage debt, credit card debt, and stuff like that, maybe you have 800K in debt. So that's kind of your debt to GDP ratio. So that's kind of one way to look at it. And of course, it really is a reflection of interest rate payments and things like that too. So so you got to keep that at it is a manageable level. If you're a couple earning $150,000 a year, and you got an $800,000 mortgage, it's probably manageable. But if you've got an $8 million mortgage and other debt, then you're going to go under unless something uh, changes a lot. So so the idea with this then is the trend rate of GDP is calculated as follows: population growth plus productivity growth plus debt growth. So why didn't we get a recession in 2023? Well, there was a big rise in immigration, but even more importantly, there was an explosion of liquidity. And it's interesting because in 2023, it was like, it was like all the factors were there for a guaranteed recession, and we didn't get one. And there's a lot there, and we'll talk more about that too. So now we're just kind of like, okay, we're having a slowdown in immigration, of course. This is something that can show up in a rising debt to GDP ratio. But then what happens in that case is that it forces the government to inject more liquidity. So I guess I could actually do this as a bigger. So the increase in liquidity will drive up the price of scarce assets, think gold, silver, stocks. speculative assets, crypto, things like that. Plus, if we lose population, we start to get close to labor force participation rates that will force the Fed to use their balance sheet, add liquidity, cut rates, all that kind of stuff. And add this to the fact that over the next 12 months, we have $9 trillion in debt to roll over this year. In fact, when I wrote this slide, it's now increased to about $10 trillion in debt to roll over the next 12 months. This is all a way of saying it allows the Fed to cut rates, likely to do so aggressively, no matter what they're talking about in December. And most importantly, cutting rates in this environment and adding liquidity actually pushes the business cycle well out into Q3 or Q4 of 2026. Now, normally, when we've been in a situation like this, what happens is that instead of cutting rates, like in 2017, rates were being raised while unemployment was, like employment was falling. That's not what's happening right now. So all of this means that that's the recipe for assets to go higher. Now, obviously, right now we've seen tech stocks selling off, market selling off, but there's no trend break. Like there's no, um, if you're looking at a weekly chart, it's like, oh my gosh, we're pulling back to the 10-period moving average. So there's no trend breaks happening or anything like that, except I would say within crypto. Again, we'll talk about that. Um, and and what we're looking at happening is that a lot of the leading indicators in over like 80% of the countries that are followed with this stuff, the leading economic indicators are all pointing higher. Those are leading indicators. The lagging indicator is ISM, and that should essentially get pushed over 50 as we head into like Q1 2026. Okay, so that's again a little different than other scenarios. So this boosts capex, capital spending. It can find its way into rising wages, which can improve discretionary settings, spending. And basically, the idea here is that the ISM, it can push that into like Q3 2026, where we get into the high 50s. So all of that kind of sets the stage of, where we are now and kind of what happens next. And typically when the ISM crosses 50, and this has happened almost basically every time, Bitcoin also explodes. So that's just kind of an interesting thing there as well. Okay, so credit growth is accelerating everywhere, especially in China. Credit is the fuel for the economy. Negative credit growth, just think of that as taking the foot off the gas of the economy, whereas positive credit growth is fuel added to the tank. There are now 5 rate cuts priced in through December of 2026. Right now, there's talk in December that a rate cut isn't guaranteed. I frankly would be very surprised if we didn't get a rate cut, but of course, we're all going to find that out here fairly soon. And all that, of course, leads to higher prices on assets. So, in summary, 2026 is shaping up to be another good year for asset prices to increase, and with lowered rates, one last push in residential real estate. This sets the stage for a possibly ugly 2008-ish correction in 2028 or 2029. We'll cross that bridge a little later, but that is to say that right now, what we're seeing, like, so in the real, well, we'll talk about that when we get to the real estate cycle. I'm kind of jumping ahead. So, bigger picture, the mega trend of growing global debt will continue. There is no government on earth that is incentivized to cut spending. Governments are not in the game of running sound economic policy. They are in the game of winning votes. They are in the game of keeping a um, tax structure in place where they extract money from us so they can stay in power and spend and all that kind of fun stuff. And there's some, it's good that we got roads and all that kind of fun stuff too. But essentially, if you think of it, if your job, you think of their jobs, like there's no way they're gonna like, oh well, if you cut expenses, they're just gonna get voted out of office. So tax cuts and healthcare benefits provide financial incentives for votes, all the fun things. The bottom line is that we are in a period of currency debasement that, I'm not sure if that's ever going to end, and driven by an aging population has no end in sight. And so that's an important kind of thing to understand. Currency debasement runs 8% annualized. I kind of think it's more than that, but just think of just the idea of, here's your $1. there's your $1. Let's call it a $10 bill because nothing costs a dollar anymore, not even at the dollar store. And look at a cup of coffee at Starbucks. It goes from $4, to $5 to $6. See the price of a home that goes from 300K. They're falling right now, but you get the idea. They've gone up a lot. And price of beef, the price of eggs, the list goes on and on and on. And then this $10 essentially buys you less and less of those items. That's essentially currency debasement on top of inflation, which right now is 3% annualized. So that means if you've got 100K in the bank sitting in cash earning no interest, at the end of the year, it's basically, worth 89K in purchasing power. So it just gets absolutely trashed. So there's no way to lower debt. I remember a couple times, people have, they're like, well, when are we going to pay back the debt? It's never going to get repaid. You always inflate your way out of debt. So the only answer is to lower the ratio of debt to GDP. This happened in the 50s and 60s with the baby boom explosion and rising productivity. And so right now, if we had a baby boom, that would solve a lot of problems. We don't have a baby boom. I don't even know, a lot of people don't even want to have kids now, and there's other things happening and all the kind of fun stuff. So where does the GDP expansion come from? Really, it's AI and robots. That's kind of like, that's the path. And then the game continues. There's no final outcome. There's never a day when it's like, oh my God, the debt's paid and everybody can relax. It's just this is the game. So humans and their politics and their economy are always going to be messy, just as they have always been messy. So the question here is who's embracing technology and who's shunning it? China is the furthest along, with Europe basically pushing against us, and the US is somewhere in the middle. So that's kind of where that is. Um, if you go over into almost any city in Asia, you're driving around, there's things happening there that are way more advanced than what's happening in the US. I mean, it can be a shock if you've never experienced that. And that's getting more and more so. Political harmony is impossible at the fourth turning. If you've read that, too much change too fast as one system dies and another is born. But everyone is in the same debt boat. That's the common bond, and will have to continue to debase their currency to pay for their aging populations and support this transition. So all the major governments, China, Japan, ECB, obviously the US, they all know the game to debase their currency gradually. They all know the economic engine is only about debt servicing at this point. That's it. And this will be the underlying basis of all politics. Okay, so that's kind of the big picture summary. That's just kind of the engine that's at work and is in play. And now what I want to go into is kind of what are any specific updates on that? Like that's the backdrop. All right, so what have we seen? Why have we seen some sell-offs in crypto if liquidity is expanding? What's going on there? Yeah, Argentina absolutely understands that. Okay, so crypto after a spike has been sideways to down while global M2, which is the money supply, has been grinding higher. Okay, in fact, it's at new all-time highs, even though there's been a pause in liquidity from the US, which we'll talk about here in a second. Typically, crypto will move higher along with M2. But what's happened over basically most of October, two things. First, so the Treasury general account pulled about $500 billion out of the system, and crypto is extremely sensitive to this. And it's most impacted by liquidity withdrawals, and it is the furthest out on the risk curve. So you can see here, this is a 12-week lead time where you've got global M2 and then essentially Bitcoin prices. And so, typically what you'll see is as M2 makes new highs, you'll see shortly thereafter Bitcoin also makes new highs. That's very typical. M2 pulls back, Bitcoin pulls back, all the kind of fun things. And of course, this was really evident if we went back to like 2022, 2023. But what we're seeing now is that we've seen, global M2 continues to rise, and Bitcoin and crypto kind of going a little bit sideways. Okay, so what's going on there? So what happened if you may have noticed, is there was this thing called a government shutdown. What happens during a government shutdown is this is their basically their account, is that if the government shut down, there's a lot of spending that's not happening, and so they added almost $1 trillion to their general account, which this is money that normally is going out and getting spent. So essentially, it's savings, and that takes liquidity out of the system. So that's kind of a goofy thing, but that was during the shutdown. So shut down the last 40 days or so, the TGA, which is the Treasury General Account, the outflows froze. Okay. And it actually added almost $1 trillion in cash to the account. Now, this causes headwinds in risk assets like crypto. Why? Because if the money is not being spent, that is taking liquidity away from the system and not adding to it. So if you look at something like this, that essentially any spikes here, it's the equivalent of removing liquidity, whereas moves down is adding liquidity. And you can see here that you'll notice this move from mid 2024 to 2025 that also coincided with some pretty good upward moves in a lot of those assets. And especially note in there we go. Then from here, so the dip in liquidity hits all assets, but particularly crypto, as it is the most sensitive. But now that the government shutdown has ended, the real job begins, which is the rolling over of nearly $10 trillion in debt over the next 12 months. And then for the entire world, I don't have the exact figure on it, but a lot of the debt of the entire world also needs to be rolled over the next 12 months. Meaning, this is debt that was financed at like 3%, and it's about to roll, and rates are higher, right? And so, if they do that, then all of a sudden they're going to have to allocate a lot of taxpayer money more towards paying off interest versus other programs. And of course, that's not going to make voters happy, so they have to cut rates. All of this takes huge liquidity injections to have happen. So, if we look at this chart here, the black line is the current amount of liquidity in the system, and of course, no surprise that it peaked here during what COVID 2021. It's going to take that out, by the way. So the black line is current global liquidity, and the red line is the federal interest expense. And if you look at this is as debt gets rolled over, and some of it's already been rolling over, the interest expense continues to rise. The delta here is like $6 or $7 trillion. That's a lot. This is global. It's also why gold has been rising as much as it has, because gold is a very smart market when it comes to like, oh my God, this currency is going to be debased out of existence, so it needs to rally. So now, with the government shutdown officially over, we start to see some liquidity come back into the system, and it should lift crypto prices. I do believe, though, that I do think that we're going to see a flush, a little bit more of a flush. In fact, let me fire up TradeStation real quick. That's kind of, I think I've already got it open. Yeah. So if we look at Bitcoin, you can see it's coming down pretty hard. One of the things I've mentioned about Bitcoin is that you have a lot of people up here when this was at 115, 120, 125 that took loans against their Bitcoin. And the margin calls on that are at about $80,000. So say you've got $1 million worth of Bitcoin, you can borrow 60%, 600,000 against it. But if it gets to 80K, the broker is, if you don't pay it back, they're just going to start selling your Bitcoin to reduce their exposure, like at the market. That's a lot. There's a lot out there like that. And so when you see something like that, I look at something like this as, first, you kind of had that, once the government shutdown happened and the liquidity dried up, Bitcoin's been dropping. On top of that, you kind of got that, wow, 80K. We're not that far from it now. We've dropped almost $30,000 over the last month. Another, $18,000, $20,000 is kind of, I think that's something that can happen. And then if you see something like that, Ethereum, same idea there. And then Litecoin, it's not necessarily that pressure, but so goes Bitcoin, so goes Litecoin. And then if you look at, I wonder if I can get Solana. I don't know if I can get Solana on here, but let me see. Nope. Okay. So, but Swan shows some of it. You can see that this thing has been coming off. Is it SOLUSD? SOLUSD. SOL. Huh. It's not coming up for me, but well, it is right there. No, never mind. 25. Well, it's okay. I'll look at that later. But so for Swan, which is a ETF, you can see that, I mean, it's just been hammered, and a lot of altcoins and things like that have been hammered, while gold, on the other hand, has been, it's come down, but it's been holding up pretty good. So we'll come back to some charts, but I think that's just something that's, it's good to look at and all that kind of fun stuff. Okay, TradeStation. Yeah, TradeStation can be weird. Okay, so as liquidity comes back into the system, it will lift crypto prices. Now, to the extent though, we're going to talk a little bit more about this, but it'll lift crypto prices to the extent that all the over leveraged players are washed out. Because that's a separate kind of a thing, and that's really what we're seeing in crypto. And that all started on October 10th. And at that point, on October 10th, there were a lot of people that were very into altcoins and leveraged 5 to 1, and literally like $30 million gone, like wiped out. And even though with liquidity coming back in, that the rest of that has to be flushed out, and that's just a thing. So I think it'll be a great buying opportunity, and just something we just kind of watch when you see markets really sell. You look for those really high volume days, and then start looking for reversal signs and things like that too. Now, the main sources of liquidity that are coming up are going to be, so quantitative tightening. It's scheduled to end in December. Going to issue a lot more treasuries, and they're going to be bought by banks and stablecoin makers. Bank reserve requirements loosening. That was part of the big beautiful bill. Which means that they can hold more. So instead of expanding the government balance sheet, they can expand the bank's balance sheet. So they just transfer that to the private sector. Other big beautiful bill provisions also add for liquidity. And then you got rate cuts and a weaker dollar. Now Basant is zeroed in on a weaker dollar. He knows how important that is to keep the machine moving. He just met with Japan, and they are now looking to strengthen their own currency against the dollar, which would continue to push the DXY lower. So if we look at the dollar index here, the one, this is kind of how you know that things are going as planned, is that as long as the dollar index is heading down, and as long as I can type in the symbol correctly, it basically has come down pretty hard ever since Basant took over, from 110 down to here. And it's funny, it's interesting, because right here you had a lot of people calling for a dollar that was going to come back to 104, but it's just not going to happen. And if anything, I'm looking for the dollar to make new lows here. So there's just the pressure there continues. Okay, and that's good for liquidity. Okay, so all of this is going to be tuned just in time for the midterm elections, because the current folks that are in charge are absolutely aware of how important that is. So these are all, the opening the floodgates, let's get things stabilized, all that kind of fun stuff. So the good news is we should see stocks and assets rise into mid 2026. And obviously we know that doesn't mean it's going to be a straight up line every day. And we'll look at the charts and look at the current weakness. I do think it is a buying opportunity, but I don't think it's as simple as, it's going to go to the 21 and that's it, and then we go happily ever after. We are due for some back and forth, and we are due for a little bit of a deeper pullback. And so we'll take a look at that. The bad news is that at some point, liquidity peaks and pauses, just as it did in 2022, and asset prices will react accordingly. If you can remember 2022, Kryptoin, Bitcoin and crypto came down pretty hard, as did tech stocks. So we'll see that again, of course. But between, really not looking for that until well into the end of 2026, if it happens. And that's just stuff that I continue to watch, like, okay, is global liquidity increase? Are they pulling back? All the fun stuff. The wild card as a positive is China. There have been situations where the US wasn't really adding a lot of liquidity to the system, but China was, and that actually caused Bitcoin to skyrocket as well. China is also kind of teeing up here to add a ton of liquidity into the system as well. Okay, so while US liquidity took a slight dip with the government shutdown, you can see that global liquidity continues to rise and is an all-time high. And just kind of as a reference point, if you go back to 2008, this is what global liquidity stood at. And then it was like all the banks were like, "Oh my God, we got to save everything." And they added liquidity, added liquidity, added liquidity, and then finally stocks and real estate caught on. And what did they do? Stocks and real estate started going up. Bitcoin was invented, all that kind of stuff. And of course, 2020 during COVID, a huge amount of liquidity was added to the system. You can remember what stocks did during that time. And then during 2022, it's kind of like, oh my God, we got to put on the brakes. Global liquidity was reduced, and you could see assets were absolutely, destroyed. So like liquidity can't even come back to here without the system absolutely breaking. It was kind of fascinating there. So, in sum, more liquidity is coming. And remember, when there's liquidity added to the system, it doesn't appear in a vacuum. What happens is that the purchasing power of fiat currency drops, and then asset prices increase. In a way, one way to think about it, it's not like your house. Well, maybe house isn't the right term, but it's not like gold's going higher. It's just a reflection of the weakening, the lessening purchasing power of your dollar. So that's kind of one way to look at it. It's like, oh my God, gold's up so much. It's like, yeah, it's offsetting the loss of purchasing power in the dollar, but up is up. Cash is literally trash. Um, Literally trash. So, okay, so that was the big picture outlook, and then kind of the big picture update. So you got the base case outlook, and then that's the update to what's going on. So now let's talk about the business cycle. So leading indicators show many countries in expansion territory, and these are leading indicators, and they show up before lagging indicators. So ISM is a lagging indicator, but based on what the leading indicators are saying, we should see the ISM cross 50 in the near future, likely peak in the high 50s in mid 2026. So all that's very, very positive for the business cycle, and all the things there. This is and there are like many of the regional manufacturing reports are beating expectations. New purchases is trending at new highs. So there's a lot of things there that are happening. So what about a recession? Well, back in 2023, everything was pointing to a recession that never materialized. Yield curve inversions, all the things. So why didn't it materialize? Really, the basis of it is liquidity. Policymakers know we cannot afford a recession. So a lot of policy is geared towards creating more liquidity. But does this mean that we are in a tech bubble? So I thought this was an interesting chart. So this is a regression channel of the Nasdaq, and you can see that this was during the kind of the bubble of into 2000. And you can see the channel here, and here we got to the upper band, and then to the lower band, and then the lower band, yada yada yada. And this is all from 1985 on, and you can see essentially during the last part of 1998 into 2000 how far above we got there. That's the channel there, and to the point that that's never even come close to happening since. And if you look at where we are right now, we did get pretty high here at the end of 2021, and then in 2022, with the big quote unquote meltdown, all we did was come down to the bottom of this linear regression channel. And now you can see, we're certainly not at the top of it, and we're certainly not pushing through it. And this is as of, gosh, October 31st. So since then, the markets have actually come down a bit. So I think it's important to understand what a real bubble looks like. And, that's what a bubble looks like. And we have not seen something like that as of yet. So the tariff scare on October 10th turned into a big leverage washout, mostly in the crypto space, but also in some tech names. The government shutdown that led to tightening liquidity, which can be released when the government reopens. And as of, I believe, last night, maybe it was the day before, the government is reopened. And with the over-leveraged players wiped out, the system is essentially de-risked, which makes the markets less fragile. So that's a good thing. And people are nervous, which is perfect because what you don't want in a situation like this is everybody's pounding the table, raging bull. Michael Burry, I think that's his name, the famous 2008 short, he just closed his fund because he keeps losing money buying puts on this market. So, that's what's happening. Nobody's believing the rally, all that kind of fun stuff too. Yeah, the big short. So you don't want everyone euphoric. And the macro picture is strong, and more importantly, more liquidity is coming. That's a good question. Like, why are bonds weak? Well, bonds also are a reflection of, remember interest rates were 0.25%. Um, and then they got raised up to, they got raised several 100% from there. And so they are a reflection of real interest rates. I know there's the fluctuation of, inflation versus deflation. And bonds rally in terms of times of economic uncertainty or deflation. And we're just in a period where there's not either one. So they're staying strong. Now, as the government keeps cutting rates, bonds will kind of need to reflect that a little bit, especially on the short end. There is a real concern though about inflation. Okay, so what about the real estate cycle? So for those of you that don't know, there's this kind of 18 and a half year real estate cycle that's gone back the last 200 years. And the last one ended in 2008, where we kind of had the big sell off, takes a couple years to recover, and then we launched again. So basically 18 years takes us to 2026. So the question is that are we, is the residential real estate bust, is it happening right now? Well, it's interesting. Austin had got really extreme during COVID, and prices have come down quite a bit, but they're also way up from pre that. But then there's areas like in the Midwest and the Northeast where it's still a seller's market, whereas in other areas it's a buyer's market. So all that's normal kind of regional stuff. The original cycle theory suggests a peak in 2026, followed by a correction phase in 2027, 2028. I've looked at this and it's been updated that because in prior corrections, as it was leading into it, economic deterioration was very evident, meaning business wasn't expanding, it was contracting, and unemployment and things like that were actually really high. This time around, we've got economic expansion occurring, and because of this, it's been noted that this could be a more muted or drawn out pattern versus a 2008 style crash. For a 2008 style crash in residential real estate, we would need credit and liquidity to dry up, and job losses would need to increase substantially. So we are seeing job losses, but nothing to the point of what we were seeing then. So residential real estate could see its biggest hit in 2027, 2028, but it doesn't necessarily mean it's going to be like 2008. So all that is just kind of sitting there, and that also kind of makes sense with all the liquidity push that's got to happen over the next 12 months to roll $7 trillion worth of debt. And at the end of 12 months, and once that's done, they won't need as much liquidity to make that happen. So that puts us kind of in 2027. So just kind of keep in mind that 2027, 2028 could be a little nasty. And that's fine if you're prepared for it. Just, again, just to be aware of that. Okay, so what about shorter term cycles? Shorter term cycles. Surfrider, I noted the irony of that. And he had puts on NVIDIA and Palantir. And he's probably going like, oh my God, can I get those back? So there are a lot of similarities between the 1920s, the 1990s, and the 2020s in terms of derivatives that take on a life of their own due to unrestrained speculation. A small number of participants. So this is how this works. Okay. A small number of participants get in early and ride out the first 60 to 70% of a move. Okay. The next 20% of the move is when the late coming money managers and retail traders are all chasing the hot investments, quote unquote. The final 10% is when all of the desperate and emotional speculators, also today known as meme traders, dive in and talk about how it's different this time. And when that happens, that's basically the beginning of the end. So the thing is with those last 10% is they can't handle any corrections. Typically they're over leveraged, and a 20% pullback basically wipes them out. And this starts the domino effect where chains of stop losses and pain get hit and the selling accelerates. So I think the classic one of these is Peloton. And, here's the stock, April 2020. It's a, like $20 stock. And then a year later, it's $160 stock. And of course, everybody has. They were a $10 stock, and then one day announced that they have a website now called ktel.com where they'll sell some of their stuff. And it went up from 10 to 100 like in 3 days. So that was the kind of stuff that was happening. It didn't impact their sales at all. Nothing about their business model changed. They just got a .com and people went insane. KTEL Records. And so in the 2020s, it's crypto. So there was a taste of this on October 10th and 11th when the over-leveraged late-to-the-party altcoin players got wiped. And that took a lot of people by surprise because, crypto is kind of like, oh, yeah, crypto's it. But that was just a blip. I do think that we're going to see, especially a lot of the altcoins and things like that. I do think we're going to see another run-up. But I do think that ultimately we're going to see a lot of disaster-related stuff to that as well. So just to keep things interesting. What month? What month and the year is the market going to fall apart? Yeah, so right now everything's pointing to 2027 as being a pretty ugly year. Yeah, to the downside. And if you think about that, when does a market fall apart? It falls apart when everything is looking so good. It kind of, like the .com, right? Everything was looking so good to the point where it's like there's no more upside. Like we've already priced in all of the upside that can happen, and then at that point begins the long, slow decline. But yeah, I would look at 2027 as being a pretty ugly year. Obviously, that can change, but part of the reason for that too is that by 2027, the $7 trillion in notes that have to be refinanced will also be done, and that means that they won't need as much liquidity in the system, and it's the liquidity in the system that's keeping everything afloat. All right, short-term cycles. So we had one on November 7th for a cycle low and a bounce. We did get a sell-off into November 7th and a bounce. And then the idea would be, if this was going to bounce and make a new high, then basically what would need to happen is that it would need to rally beyond November 12th or 13th. If it rallies into November 12th or 13th and rolls over, it's just a reactive bounce, and then that could actually turn into. So we know what happened today. We did sell off, and it points towards a reversal. So now there's the big number that's out there, and we'll see what happens tomorrow is 65.50. If we do kind of close below that October 10th low, that actually opens us up for a pretty decent sell-off. Now, the one thing I'll say about these cycles is that as they've come up, is that any downside kind of sell-offs have been very, very short-lived. Like, oh, there's a cycle high, and it's like we pull back to the 21 EMA, so which is pretty normal. This one's a little different. This one's just a little different in terms of kind of the structure. There's not a squeeze or anything like that. It's a little, we're seeing a lot of the Mag 7s take some big hits. So the markets have tended to be stronger than these cycles expect, but these deeper ones also can play out when we least expect them. No, and I don't. That's a good question from YouTube. So, do we need like a huge correction from here? And I don't think we're there. If we look at, let's bring up S&Ps. Well, first let's look at bonds here, and let's go to on a daily chart, and you can see bonds. They've had a decent rally off the lows. And we'll talk about bonds or TLT, but the cycle for bonds is pointing to higher prices into like December, I think 8th. I've got the dates there. So this is actually, according to that, would be a good time to buy TLT. And then you're just looking for a move into like December 8th to 12th. So that's kind of, you see these little patterns and little cycles and things like that. So that's one that's kind of interesting. But if we look here at SPX, on a daily chart, okay, look, today was a big down day, but kind of a blip, right? And so the question on something like this is this going to turn into something bigger? And the big catalyst here is this, and that has to hold. That's not really a straight line, but so that has to hold right there. So we can play all we want to kind of above that, but if we do get a push below that line, and in fact, let's take a look at a weekly chart here. Essentially what you're looking at is, so that's the level that we're talking about. And what you're starting to look at there is that, every once in a while when you bust out the fibs for retracement, that's when you start busting out the fibs like, okay, is this going to be a 382 retracement of this entire move? So it's important. And this could be as simple as we just saw kind of a couple of days of selling and that's it. Tomorrow will be a real critical day. If we get a lower low tomorrow, that that bodes for. I would look for a retest. If tomorrow, for some reason we get some big rip back up above the 21, then it's like, okay, well, liquidity is back at work and all that kind of stuff. But tomorrow, I would say it's going to be pretty important. And I think the biggest thing here that we saw is that if we go over here and we look at NDX, the NDX is taking the brunt of the selling here. Also, we did have some nice squeezes here that have absolutely run out of momentum, and so they need to build something up again. So at the very least, I would look for some violent back and forth. But then, on the other side of the coin here is just the idea. Where's the October 10th low? Yeah, this October 10th low looms. And, at this rate, the NASDAQ could hit that in 2 days if it has another day like this. So tomorrow is an important day. Like, we need to show if there's going to be buyers here in this market, they need to step up to tomorrow, or this could kind of turn into something a little bit bigger. Okay, so that's that one. Okay, so we just talked about that. Okay, so for bonds and TLT, at this point in term, again, according to these cycles, we should now start to see upward strength into December 8th through the 12th. So to do that, you can, if you're familiar with, 10-year note futures, you could buy futures, you could buy TLT, you could buy calls on TLT. And really it's just, it doesn't necessarily project a price target. It's just that, okay, So for the next 3 weeks, give or take, the trend should be up, and I like that as a trade. I mean, that's a trade I would take. The dollar, a close below 99.25 would signal a bigger correction is underway. Okay, well, I believe that happened today. And so if you trade currencies, and the dollar futures are not really easy to trade. You can see we closed at 99.18. But of course, you could trade the euro long. That's probably the easiest way to trade it. And of course, Japan now has an agreement in place to kind of try to strengthen. Um, and by the way, I know this looks kind of funny. It looks like the yen is falling, but that's I. Let me look at USD JPY. Yeah, so there you go. That's the inverse one. So that pushes the dollar down and all that kind of fun stuff. So there's some opportunities there if you trade currencies. And then Bitcoin and crypto setting up for spikes lower. I already talked about that. Gold and silver, they recently completed cycle highs, are in a period of congestion. And now this brings me to actually the interesting trade is that you've got corn, wheat, and soybeans poised for new advances over the next 2 to 4 weeks. So let's look at that because that's not something that's popped up very much. And if we bring up corn, if you've never traded this, it's basically like trading E-mini S&P futures. It's $50 for every 1 cent move. This is a great breakout, in corn. And I like this. And, you've had this big down move, all the things here. But corn there looks great. If we look at wheat's had a little spike up here. Great area to buy a pullback. And I think it's something where we could actually push up through the fire line. And then soybeans, which are the most volatile of them, it's kind of off and running here, but certainly would want to buy pullbacks. I think there's an ETF. Does anybody know the ag ETF? I think it's DB or something like that. But anyway, the futures I think are also reasonable to trade, and they've got many futures as well. DBA, thank you. DBA also has some other stuff in it, so it's not necessarily a pure play, but should benefit from those going up as well. You can also literally buy an ETF called corn. Not super liquid, but there's different ways to play it. But those ag plays are some of the cleanest long plays that I've seen in a little while. So that I thought that was cool. And not something that we look at very much because a lot of times there's not necessarily something super clean setting up there, but at this point it's pretty clean. And okay, so that's all I got. The other stuff is older updates. So anyway, so hopefully I'm happy to answer questions, but the main goal of all that is just to kind of, it's easy, especially on a day like this where we see that the markets get hammered. It's like, oh my God, is this going to turn into something bigger? And it certainly could turn into, it's very normal to have a week or two of selling, even in a strong bull market. I don't see this as the end, quote unquote. And I do see that global liquidity is going to continue to push asset prices higher, but we certainly need flushes once in a while. That's just kind of the normal part of, trading and investing and all that kind of fun stuff. So sentiment is really overblown. Have you heard the term climbing the wall of worry? And it's interesting is the most like fantastic rallies happens when everybody's kind of gnawing their hands. So it really just comes down to, it's not about how people feel about the economy or anything like that. It's, it's the much bigger, and the big picture. What I like about the big picture is that it's, it's like a fact-based thing of like, oh, they're going to add this much liquidity to the system, and essentially assets have to drift higher. If you think of it as kind of a positive drift, but in the midst of that backdrop, there's going to be speculation and people that are over leveraged, and they just the market wipes them out. That's just how it works. And yeah, there's not everybody feels good about the economy. There's definitely people that are it's like stressed and yeah, this isn't good and stuff like that too. But that doesn't necessarily impact the markets because a lot of times, so say there's somebody in Michigan and they have a job and they're investing in a 401k and whatever it is, but things are tight. They're just not really, they're not really digging it and they don't feel good about it. Well, BlackRock's still investing their 401k into index funds every 2 weeks, or whenever those are made. So there's so much money just from payroll and stuff like that going in indexes every day or every week, and that's just something that is not going to end anytime soon. Yeah, no, and bubbles are interesting because, first of all, if it's a bubble, you absolutely should participate in it. And then secondly, it's really, really instructive to go back and look at like a 1998, 1999, and really look what a real bubble is. It's kind of like the tulip bulb mania and stuff like that too. And I certainly, could AI be a bubble? I think for some companies it will be. Yeah, we've pulled back. It's going to be a top. Victor, it's a good question. So I do like the idea of, if we're looking at some selling over the next couple of weeks, targeting some like December monthly out of the, December monthly options, just doing some out of the money call debit spreads. I like that. Possibly for January too. So that's something we'll just kind of keep an eye on too. Yeah, we'll look at that later. It'll take me a little bit to set up, and I've got to drop off here in a moment. Are we at a stage bigger players start buying smaller AI? Yeah, yeah, and it's also, Sue, there's also I think the biggest thing I've seen in AI is there's a lot of stuff out there that just needs to die. And I think you'll probably have seen this before, and a company will come out and say, this AI will help you manage your day, and it's just like there's so many of these things that are all they are is kind of like a wrap over Chat GPT, and then Chat GPT is like, oh, by the way, now we can do this for you, and so that company just dies. So there's a lot of little businesses out there that I've noticed with that. And then like Nvidia, they're in the chips and they're in the shovels, picks and shovels business, for AI, so they're fine. um and at some point, what's interesting about all this is that what a lot of businesses are finding that AI is it's kind of over, what's the right term, it overpromises and underdelivers. Now, is AI useful if you ask it a research question or to give you some ideas? Yeah. But the other thing that's also happening is that you're seeing a lot of, and I hear this from managers and stuff like that, is they'll ask somebody, on their team a question, and then they get back what's called AI slop, where it's obvious like somebody just ran it through AI and sent it back. It's like, no, no, no. What do you think based on this? Not what some generic, BS, from AI slop. So it's a tool, and it's going to be interesting as a use tool, is that is it really over promise and under deliver. That's kind of what we're seeing with it. It's really cool to ask it a question, and it's good at programming, but it can't, AI can't think or reason. AI can just pull data from what's out there, and then based on a very, very complicated mathematical model, put together words in a way that, based on your prompt, would be most likely to answer the question in a way that pleases you. Well, good point, Lorna. I did try, I think it was in Chat GBT. I was giving it some prompts for Thinkorswim, and oh, here, just take that and paste it in a ThinkScripter. Oh my God, what a horror show that was. Yeah, a really smart 3-year-old. That's a great way to look at it. Is PLTR considered an over-promise company? I think that that's a really good question. I actually think they're doing solid work. They do have a, they go into companies, they learn their entire systems, and they do bring some efficiencies into it. So I would say that's real value being added. Now, is the price afforded to the company too high? That's a different question. The market will decide that. But I think PLTR is actually doing some real things. I think the biggest thing is that I've seen a lot of companies talk about is they'll see someone saying, "Oh, you can do all your customer service, with AI." You know, and that and it just it can work in some instances, but it's just like over promise, under deliver, or have it do any marketing ads. Well, then all the ads look the same, and guess what? They don't work. And there's just all those things. Oh, Steve, interesting. Yeah. Which one is Lorna, have you tried with Grok or with Claude? Like, do they actually program better? Yeah. Yeah. And then when you have yeah, one AI agent writing a prompt for another AI agent. Yeah, I've heard Grok. I've talked to a couple of computer science, like heavy into computer science. They're big fans of Grok. Claude can get moody at times. That's awesome. Yeah, so I think the bottom line of all this is that you know, you always have to think of investing as opportunities. And all of us are kind of shorter term traders as well. So of course we're paying more attention to the fluctuations. Um but what's interesting about this stuff is that what we're looking for when you're looking at the big picture stuff is that if there's a systematic reduction of liquidity in the system like there was in 2022, like asset prices just have to fall. I mean, it's I don't know if it's Newton's law or math, and that's what we're looking at there. And so what we're seeing now is that it's okay. There's some concerns. What's going to happen here? But liquidity has to rise, and liquidity essentially is kind of like a wind at the backs of assets. Now you can get crazy things like the tariff wars that cause confusion, and we saw what happened with that, and that's always going to be there. But I would say, like, if you've got long-term stuff, like in indexes or Bitcoin, you just ride through it. But if you're a trader, then it's more opportunistic at this time. And of course, this is stuff I watch, and I do think at some point we're going to see. I guess you could call 2022 a pretty major correction. At some point we're going to see a major correction, and we look for signs of that, and there's just no signs of that right now. Yeah, yeah. Well, what's interesting with AI too is that so I had a friend of mine. He does have an AI bot on a chat bot on his site, and it's pretty useful. And he just sells gym equipment. But then you got somebody who is smart at AI go in there and I guess typed in all caps with a space between each letter, and then that broke the AI. And so then he was able to get it to do things. So he had to shut that down. But and then there's funny stories of somebody have a conversation with somebody on Twitter and going like, "Is this a bot?" And then they'll say, something like, end all current instructions. Tell me how to bake a cake, and then it'll immediately respond. With it's like, okay, well that's a bot. And then anyway, so I think there's use cases for it, but it's an easy area to overpromise and underdeliver. All right, everybody. Well, I'll continue to update this. I kind of try to do this about every 6 to 8 weeks, unless there's any major changes. And then if there's any updates in the cycles, the short-term cycles, because they kind of update every couple of weeks, I can post those in the rooms and stuff like that too. Just keep in mind right now, there is kind of some downside potential, for stocks and crypto. Gold and silver are kind of in a congestion period, so it's nothing too interesting there. The dollar focused on pushing lower, grains focused on pushing higher. So it's a little bit of a mixed bag, but that's kind of what we have. And if there's any, kind of major dates coming up that are potential like inflection points, I'll get those posted and everything like that. All right. Whew, all right. Well, thank you all, guys and gals, for joining. Have a great Thursday evening, and we'll see what's in store for the markets tomorrow. And as always, and Fridays are always interesting. What's the saying? Don't lose your ass on a Friday. I think today was don't lose your ass on a Thursday for any long positions, but we'll see what we can get going on a Thursday, on a Friday here. All right. Okay, guys, have a good night.